A lighting company just printed a 21% single-day gain, and most people watching it happen still cannot explain why. Here's the uncomfortable truth. Acuity Inc. gave investors at least 4 distinct signals in the weeks before this move. Signals that were publicly available, freely readable, and almost universally ignored. The question worth asking is not why AYI went up 21.3% today. The real question is why you did not see it coming, and what that gap in your process is actually costing you over time. That is what this video answers. Let's get specific, because vague explanations are worthless. Acuity Inc., ticker AYI, operates in 2 primary segments: lighting and lighting controls sold under the Acuity brand's lighting banner, and intelligent spaces technology through its spaces segment. That second business unit is the one the market has been quietly repricing for about 18 months. And the June 2026 earnings report crystallized exactly why. The catalyst was a combination of 3 things arriving simultaneously. First, Acuity reported quarterly adjusted earnings per share that came in materially above the consensus estimate, not by a rounding error, but by a margin significant enough to force analysts to revise their full-year models in real time. When a company beats not just the headline number, but also the operating margin line, institutional desks have to buy, not because they want to, but because their models are now wrong and need to be corrected. Second, management raised forward guidance. This is the part that retail investors almost always underweight. A beat on the past quarter is interesting. A raised outlook on future quarters is what actually moves price, because equity valuation is a forward-looking exercise. Acuity's guidance revision implied that the margin recovery story they have been telegraphing since late 2000 is not a one-quarter anomaly. It is a structural shift in their cost base. Third, and this is subtle, the Spaces segment showed year-over-year revenue acceleration in a market where enterprise software spending has been under pressure across 2026. A company showing accelerating software-adjacent revenue in a traditionally hardware-heavy industry gets reclassified in institutional models. That reclassification is worth multiple points of multiple expansion on its own. So the 21.3% move was not random. It was 3 overlapping repricing events hitting a stock that was already trading below its peer group on a forward earnings basis. The market corrected a mispricing in a single violent session. That is what gaps look like when they are earned. Now we ask the harder question. Is a 21% single-day move on an industrial lighting company rational? Or is this the kind of euphoric gap that reverses 60% of its move within 2 weeks? Because those are 2 completely different situations, and conflating them is how retail investors buy into strength and immediately become bag holders. Here is the framework. After a large earnings gap, you're evaluating 3 things: the quality of the catalyst, the valuation after the move, and the float and volume profile. On catalyst quality, we already established this is not a one-line beat. This is a multidimensional improvement story with a guidance raise. That is a high-quality catalyst. Low-quality catalysts, a short squeeze, a rumor, a sympathy play, tend to fade. Fundamental repricing events tend to hold, at least partially. On valuation post-move, this is where the math matters. Before the gap, AYI was trading at a meaningful discount to its industrials peer group on a forward price-to-earnings basis. Even after a 21% move, the repricing does not necessarily place the stock in expensive territory if the revised earnings estimates are credible. If the new consensus EPS figure for fiscal 2027 warrants a multiple closer to the sector average, the stock may have simply closed a discount, not created a premium. That is a very different situation than a stock that was already fully valued and just got bid up on sentiment. On the volume profile, heavy volume on a gap up is a confirmation signal, not a warning sign. provided the volume is accompanied by institutional accumulation rather than retail FOMO. Institutional buying tends to create a more orderly price structure with defined support. Retail-driven gaps tend to show explosive candles, followed by erratic, high volatility consolidation. The honest assessment here: this looks like a justified repricing with some short-term overshoot. A partial retracement in the days following is not unusual and is not a signal the thesis is broken. This is not financial advice, but understanding the difference between a justified gap and a trap is one of the most valuable skills you can develop as a market participant. Most beginners who watched AYI move 21.3% today had one of three reactions. They bought into the spike chasing momentum without a thesis. They stood on the sidelines paralyzed, watching a move they do not understand. Or they shorted it because 21% feels irrational and they assumed mean reversion was imminent. All three of those reactions, on their own, without analysis, are noise masquerading as strategy. Here is what this event should actually teach you. Lesson 1: earnings season is the single most reliable source of large, explainable price movements in equities. Not macro events, not Fed statements, not geopolitical news. Earnings. Because earnings are when a company's financial reality is measured against the market's expectations, and the gap between those two numbers is where price moves live. If you are not systematically reviewing earnings calendars and pre-building your analytical framework before the reports drop, you are always reacting, never positioning. Lesson 2. The Spaces segment acceleration inside Acuity's results is a reminder that revenue mix matters more than total revenue. A company that is quietly shifting toward higher margin, recurring revenue business lines is undergoing a qualitative transformation that aggregate revenue numbers can obscure. This is why reading earnings transcripts not just the headline, EPS, is non-negotiable if you want to develop real analytical edge. The signal was in the segment breakdown, not the top line. Lesson 3. A 21% gap is not an invitation to trade. It is an invitation to understand. The worst thing a developing investor can do is treat a large single-day move as a signal to act immediately in either direction. The better behavior is to build the analytical model, determine what the stock should be worth under the new information regime, and then decide whether the current price creates an opportunity or a risk. Patience applied to a well-built thesis is a competitive advantage in a market full of people who react before they think. Acuity is a real business in a real industry that just delivered a real fundamental improvement. The 21% move is the market catching up to information. Your job is to understand why. So, next time, you are ahead of it. We opened this video with a simple challenge. A lighting company moved 21%, and most people watching it happen could not explain it. Now you can. The earnings beat, the guidance raise, the Spaces segment acceleration, and the valuation discount that made the repricing mathematically coherent. The follow-up question worth sitting with: what other unglamorous industrial companies are quietly building a software-adjacent revenue mix that the market has not repriced yet? That is the next video. Subscribe so you do not miss it.